Well, good afternoon again. If you've just joined, my name is Jason Cleary. Welcome to the 3 Creative Ways to Lower Your Health Insurance Costs webinar, a topic that's important to almost everybody. So we're going to get started. We've got a few people still coming in, but we'll go ahead and get started. First, talking a little bit about who Member Benefits is. We are work with associations like yours. As you can see from the screen, we work with the Florida Bar, State Bar of Texas, State Bar of Georgia, FICPA, FMA, and the Missouri Bar, and some other associations. And so that's how you receive the invitation for this webinar. We provide great benefits through the association to individual members and to small and medium-sized businesses. So just to tell you a little bit about myself, I've been in the industry since 2001. I started my time at an insurance carrier where I learned the ins and outs of the different benefit plans and the different offerings that insurance carriers do. And then in 2008, I decided to move over to the sales and consulting side where I've been ever since, helping individuals and businesses make good decisions on their health insurance and other employee benefits. We're going to go through probably what I think of as the top 3 creative ways to save on your health insurance benefits. Obviously, you can see that the costs aren't going down. They continue to rise. In fact, I use this a lot. If food has gone up as much as health insurance, a carton of eggs would be about $80 right now. So we definitely need some decisions and some ways to lower our health insurance costs. So we're going to go through supplemental health insurance, how that can help, how health savings accounts can help, and on the employer side specifically, how looking at a level funded program could help with your for you and your employees on your benefits package. The overall philosophy of this entire webinar would be, don't give the insurance carrier more money than you need to. Many people are overinsured and they don't need to be. So I'm going to go through some ways where perhaps you could get creative and save, hundreds or even thousands of dollars on your health insurance premiums. So we'll start out with the supplemental hospital gap, or sometimes it's just called supplemental reimbursement plan. Just depends on the different carrier that you work with. But it basically has been around for many years, but there's still a lot of people that are very unfamiliar with it. And the best working definition would be that it's supplemental insurance plan that reimburses you for certain out-of-pocketing costs you incur, typically expenses that go towards the deductible. That's why a lot of times it's actually referred to as a hospital gap policy, because it's mostly covering for services that go towards the deductible. But we actually have some policies available where it will actually reimburse you for more services than just your deductible. As you can see, we have, this is just one option that we offer. It's 4 different options from the basic to the elite, depending on your price point and the coverage that you need. And it's going to reimburse you for the hospital services, but also for things like even your emergency room or down to minor x-rays or laboratory work. So there's different tier options that you can go for. These benefits will be paid directly to you, the consumer, to help offset your out-of-pocket expenses for deductibles or other higher copay options that you might have. And you can see one neat thing about this particular offering is that it also adds $10,000 of accidental death and a dismemberment benefit. So how does it actually work in lowering your health insurance costs? The first thing would be, just showing you these benefits, but how does it actually work in terms of cost and lowering your overall premium? So one example that we like to show, this is a very common scenario, and we work with thousands of individuals that come in and try to buy health insurance through us, and also businesses. And what you typically think is I need a very rich plan in place to ensure my financial protection if I were to have a big claim. But remember, our overarching philosophy is not to give the insurance company more money than you need to. And so traditionally in the past, there's been plans with deductibles of $250 to $500, very low copay plans. And 10, 15, 20 years ago, they were more affordable. But the prices have continued to increase every year. So those are no longer sustainable financial options. So you have two options as the prices increase. You can continue to pay and absorb the cost for a richer health plan with a very low deductible, very predictable, or, and this is the main premise of this webinar, you can get creative and still ensure adequate financial protection with a little bit of creativity. So here's an example of how that would work. Let's say you were typically wanting a gold plan. This plan, you can see it has a $1,000 deductible, and the annual premium would be $5,606. So a lower deductible. On the right side, you have a plan with a higher deductible of $6,000. And of course, because of that higher deductible, the premium is lower, $4,404. Well, if you take a scenario where somebody goes to the hospital, gets in an accident, and they're staying in the hospital for 6 days, you can actually come out ahead financially on an annual basis if you pay less premium and have a higher deductible bronze plan, but then pair it with one of our supplemental insurance products. So for example, in this scenario, they have a premium of $4,004, but their total out-of-pocket expenses would be their deductible plus the $6,800. So you take that into account plus the premium, but then on the other side of things, the member is actually going to get reimbursed $3,525 for the expenses that they incurred for their hospital stay, any surgical procedures done, and any other benefits that the plan covers. In this example, they were paid $3,525. So overall, the savings was $4,736 annually. This, again, this has been around for a while, but not a lot of people consider this because they've never been informed that you can actually save a lot of money and still have adequate financial protection in place. So probably something you really want to consider when it comes around to your renewal for your individual policy, or if you're an employer group, you want to consider potentially adding this as a part of your benefits package. I recently, a few months ago, worked with an employer group that saved a lot of money on their premium, and then because of that savings, they took a portion of it and purchased our Elite supplemental policy for all of their employees to help offset any costs. And it works very well when you do it on a group basis like that. So that's the first one. That's a very simple solution. You just have to make sure that you compare the plans side by side and do the financial analysis. The second creative solution, and this has been around for quite some time, it started to get popular in the early 2000s, and it still falls under our main philosophy, which is don't give the insurance company more money than you need to. But in this vehicle, instead of taking the extra savings that you save on your premium and using part of that to purchase a supplemental policy, you can take all of the savings and put it instead into a health savings account that's tax advantage. So what is it? What is it? It's often called an HSA, and basically it's available if you are enrolled in a qualified health plan. So the first option we talked about, the supplemental health insurance, can be paired with any insurance plan, whereas an HSA can only be paired with a qualified health plan. In fact, there may be a number of you that actually are already enrolled in a qualified HSA plan but are not taking advantage of the actual savings of an HSA vehicle. So it's a savings account where you can put in money up to the IRS maximum every year. It rolls over. It's completely your bank account. It's not owned by the employer in any way if you're working for an employer, and you don't lose it at the end of the year. A lot of people may confuse it with a flexible spending account. With an HSA, you actually get to keep the money in your account, and it continues to roll over year after year. And when you're 65, you can take it out with no penalties and just pay the normal tax rates on it. But if you just use it for normal medical expenses, you won't have any tax burdens for that. I recently, last year, came across a very interesting study that was conducted in 2015 that said in the early 2000s, 2006, they looked at the top 20 HSA providers in the country who had health savings accounts and held about 70% of the assets. And there was $1.6 billion in those accounts. By the end of 2015, those same banks had over $30 billion in their savings accounts. So what this translates to is more people were saving their money rather than giving additional premium to the insurance company, potentially over-insuring themselves when they don't need to. So again, it goes back to our philosophy. We don't want to give the insurance company more money than we actually need to. And this study proves that many people are actually benefiting from not doing that. So it does have a triple tax advantage. You save the money on any contributions that you put into the account. You can do it through your employer, payroll deductions, before taxes. You earn interest. Any interest you earn on the money is not taxed, and anything that you spend on the plans is not taxed as well, as long as it's for qualified medical expenses. I did want to point this out, and I'm sorry I didn't point it out at the beginning, and I just saw a question pop up, and there's a box on the right side of your screen that has questions, and we will get to all of your questions at the end of the presentation. We just had a great question come through that we will actually get to at the end. So go ahead and feel free to, as we continue to go through this, type in your questions. Eligible expenses for an HSA can be found on the IRS website. There's a whole list of them. There's other easier resources to view where you can actually view a complete list of the qualified medical expenses. It can be used for your health insurance, for your copays, deductibles, and prescription copays, but it can also be used for non-medical related services like dental or vision. I was able to have the benefit of using it for LASIK eye surgery. And as long as you use it for those types of expenses, you don't receive that 20% penalty or early withdrawal penalty. You can't use it to pay your premiums. You cannot use it for over-the-counter drugs, but there's a lot of prescribed medical expenses that you can use it for that you can find on the IRS website under the qualified medical expenses. Right now, the contributions that you can put in your HSA account are $3,400 for an individual and $6,750 if you have your spouse or child or both on the plan. If you're 55 or older, you can contribute $1,000 additional to that every year. In some of the proposed legislation, they are really looking hard to increase the HSA contributions, which will be a very good thing. And what they're finding is that HSAs and the philosophy behind HSAs actually helps lower the cost of health insurance overall. So of course they want to incentivize more and more people to join that. Here's an example of how it works out financially. This is a true example for a 22-person law firm that we wrote last year with HSAs. Their conventional plan had a $3,500 deductible, 80/20, had some predictable co-payments to the doctors of like $35 or $50, and that premium was $337.83 for an individual, or $1,114 for a family. When we looked at a similar deductible, a similar out-of-pocket maximum for an HSA qualified plan with no co-pays, there was significant savings. So each individual could save $847.92, or a family could save $2,798.40. And they basically can then take that money, contribute it into their HSA account on a pre-tax basis. I'm seeing a lot of employers at least make this a part of their portfolio. So a couple just summary takeaways from HSAs. They're great tax sheltering vehicles, so higher income earners love HSAs. If you're a higher income earner and you haven't considered either having it on an individual basis or offering it in your portfolio of offerings for your company, it's definitely something that needs to be considered. A lot of times you can offer a health savings account plan that's qualified right alongside of a traditional copay plan, so that employees can have the choice on which option that they want to go. So that's the top two for both employers and individuals: supplemental health insurance and health savings accounts. I've been talking about health savings accounts since the early 2000s, and time after time again I come across many individuals and business owners who have not understood the true benefits of offering one in their portfolio. So that brings us to the last option before we get to our questions, which is level funding. This one's basically going to be geared more towards employer groups, and it's just a different way of understanding health insurance that can save, we're seeing even 15 to 20% savings on level funded plans in comparison to the traditional options that you typically see as an employer group. So let me kind of go through the philosophy behind it. In 2014, the Affordable Care Act said that small groups, if you're under 50 employees, there would be no more medical underwriting. Previous to 2014, we could get a 15% discount for a group that had good health status. They would fill out medical questions, and if they were a healthy group, we could get as much as a 15% discount for that group. If they were unhealthy, they would get a 15% increase. Well, healthcare reform changed that and said everybody has to be at this 1.0 level, and they changed a lot of the other factors in the way that the plans were priced that negatively impacted them. So if you switched over as an employer to an Affordable Care Act plan, you probably saw a big rate increase. There are a number of employers who are actually still on their old non-Affordable Care Act plans under what was called transitional relief, and that may or may not come to an end. Irregardless of if you are or aren't, level funding is still an option that you want to look at. So what is it? It's basically a ERISA-based, partially self-insured health plan that's not subject to the negative Affordable Care Act provision called Adjusted Community Rating, ACR. There's virtually no risk associated, and I know whenever anybody hears the word self-insured or self-funded, they think, well, I can't do that. I'm only an employer group of 5, 10, 15, 20 people. That has changed because very reputable insurance carriers have now structured self-funded plans to come down to the small employer level with no risk. And it's basically the way that the plan has been structured, and I'll show you in a minute how that works. The benefit is you can go through financial underwriting, and if you're a healthy group, 9 times out of 10, you're going to save a good deal of premium by moving to this option. So here's kind of just a graph that shows how it works. On the left side, let's just think of this as how your insurance plan works now. You've got your fixed cost, which is their administration cost, what they think it's going to costs them to run the health insurance product and insure your company. And then they have a projected claims fund. And based on those two factors, the fixed cost and the projected claims fund, the insurance company decides what your monthly premium is going to be based on the demographics of your group. If your claims do not run at the level that they thought they would for either your group specifically or if you're pooled with multiple groups, number one, if you're under 100 employees, typically you don't see the claims data, so you will not know how your claims run. And number two, you typically still get a rate increase. So there's no transparency, and you find yourself still getting a rate increase, and maybe you look around and you say, I don't think anybody had any major medical expenses, but there's nothing that you can do about it in the fully insured environment. In the partially self-insured or level funded, and the reason we call it level funded is because you just pay one premium just like you would with the fully insured, and it functions almost exactly the same. It's just behind the scenes there's some other components. So for example, they still have their fixed costs very similar to the fully insured, but now with their claims fund, if your claims run better than expected, you as the employer have the opportunity to share in up to 50% or more of the claims savings. So whatever is left in the claims fund, the surplus, you get to share in that amount. And you will actually be provided monthly transparent claims reports that are HIPAA compliant, and you'll be able to see where you're running. So then, of course, a lot of people then ask the question, well, what happens then in the level funded plans if I run over my claims fund? And that's where this term stop-loss insurance comes into play. The insurance companies in your monthly premium have factored in the admin costs, the claims costs, and the stop-loss insurance, which is also known as reinsurance. And what that means to you is if you go over your claims fund, that is completely taken care of by the insurance carrier. So unlike a very risky self-funded plan for a very large group where they might have to pay the claims if it goes over, the insurance companies have actually made these plans now available to groups as low as 3 to 5 employees enrolled, and as long as you just pay your monthly premium like you would in the fully insured environment, there's little to no risk that you would be associated with your health plan. Here's kind of example. This is a group that I have, and here's an example of how their claims are running. One thing I want to point out is when you do level funded, because you have the ability to get money back, you start to think of creative ways to control your claims where you wouldn't in the fully insured environment. So what we do is we put products in like Teladoc, where it's a virtual doctor care that they can contact a licensed physician who will even write them prescriptions over the phone. Those services will not go towards your claims fund. This group that we're seeing here, that's actually running probably even more now. I haven't even ran the report for March or April, but they were at a $12,000 surplus. One of the big reasons associated with that is within their level funded plan, they put an HSA compatible plan in place where everything goes towards the deductible, and then they helped offset those costs by putting some extra money into the employee's health savings account. And so, of course, any expenses that are incurred below the deductible do not get put on their claims report. And the employee is just using the money that's in their health savings account to pay for those expenses. So it really works well in a level funded environment to also pair that with our second creative option, which is an HSA plan. And so in all three of these options, the philosophy holds true. You're not paying the insurance company more money than you need to. The level funded plans are similar to fully insured in their plan designs, except there's a lot of carriers that we can actually customize a plan design, where in the fully insured environment, it's kind of just a set package of options. A lot of customization from deductibles to coinsurance to office visit copays to lab work. And so we just work with the clients to design a plan that fits them and that they want to see work for their level funded options. It does go through medical underwriting, so it's important to have an electronic process for that. A lot of companies I see filling out paper forms. Sometimes those are necessary for some insurance carriers, but a lot of our options we have can be done completely electronic, and it's completely confidential, where the medical questions that the employees answer go directly to us, and then we then in turn work with the insurance companies to provide you with a medically underwritten rate. So those are probably the three top options. There's some others out there as the laws continue to develop around health reimbursements account or HRAs. That would be a potential other future webinar that we might consider putting on. But right now, these are three great options if you haven't considered them to go ahead and consider. So at this time, we'll go ahead and take questions. Let me just see what kind of questions that we have going on here so far. Okay, so we got a good number of questions here. So just bear with me. This will be recorded, and we will put it on the association website, so you can listen to it later. What is a health savings account qualifying plan? That's a great question. Each insurance carrier will actually specify very clearly what a compliant plan is. Next to the plan, they'll put that it's an HSA compatible plan. In our private exchange that we've created for the associations, by each plan that we have out there available, it'll say HSA and it'll have a little icon. But the rules are, it has to have a certain level of deductible. I think it's around $1,500 now. It can't be below that. And there cannot be any copays before the deductible. And that's an IRS requirement to actually have a plan that qualifies to open up a tax advantage account. So when you go to the primary care or you go to the specialist on a health savings account, you don't have the predictable $25 or $50 copays. Instead, you would take the money from your health savings account and pay the doctor directly whatever the negotiated rate is. And that's important. You're not just paying any random rate. You're still paying the negotiated insurance discounted network rate. And a lot of insurance carriers actually have tools available to tell you what those rates are. And I know when you don't know the rates, you generally think they're probably more expensive than they are, but you know, a typical primary care physician visit could be anywhere from $60 to $100. Specialists may range from $150 to $300. And a lot of people don't realize that MRIs at the right facilities can actually be $500 to $600 to $700 versus thousands of dollars at the hospital. So what the HSAs do, because everything goes towards the deductible and because it's actually your money, it promotes more employee choice and engagement. So that's kind of the ins and outs of the qualified plan. What if you are over 65 and have Part A and B Medicare? If you're over 65 and you're enrolled in Medicare, then you are not eligible to contribute to an HSA account. If you've had an HSA account before that, you can still use the funds in the HSA account to pay for out-of-pocket expenses, and I believe you're still allowed to even pay for your Medicare premiums at that point or long-term care premiums, but you cannot contribute. I have had the question, what if I disenroll myself in Medicare Part A and B? Will I be able to contribute into the health savings account? And the answer is yes. If you're at an employer and you want to stay on the company coverage and you disenroll yourself in Medicare Part A and you don't have Part B, then you can, even if you're 65, continue to contribute and get the tax benefits for a health savings account. Another specific question about a Gold Florida Select policy for myself and my 13-year-old daughter. I pay nearly $19,000 annually for this plan, plus I pay another $1,200 for an Aflac reimbursement plan. What would you recommend for me? Probably I would recommend you give us a call so that we could actually look at the details of your plan, and I wouldn't want to give you any kind of recommendation just off a few of those facts, but we could do an analysis for you and kind of recommend a plan that works best for you. I buy my health insurance through a solo practitioner, very expensive and very difficult to find a reasonably priced HSA policy. Why is that? What are the options? I'm not sure why it would be an unreasonable price. Typically, HSA policies are about 10 to 15% lower than the gold or the platinum options. But if you want to give me a call after the webinar, we can actually discuss your specific situation. This is another question that I researched just before this webinar. Can you have a gap insurance and HSA at the same time? The answer is yes, you can, and that's a great idea in a number of ways. So you can actually have the health savings account, contribute the money in there, save the premium, but then at the same time purchase a very inexpensive gap or medical reimbursement policy like we discussed that helps offset your costs, and that in no way prohibits you from the tax advantages of the HSA. So that's a great question. How can I get more information about supplemental insurance? That we have some options on our website, and you can also talk to one of our benefits counselor on those options. I have a platinum PPO plan through my employer, but we will be going into the individual marketplace, and my plan is not offered on the exchange. I have a dependent with high expenses through ER visits and admissions about a dozen times a year. I need to provide the same level of care without going broke and doing it. For sure, that's a great question and a great common scenario that we come across. And if you're on a platinum PPO plan, you're in a perfect scenario to look at hiring your deductible, looking at maybe a silver or a bronze plan, and pairing it with one of our supplemental options. How do insurance companies determine if a certain group is healthy or not? That's a great question. We have each employee fill out a medical questionnaire, and our questionnaires are electronic, and they usually take employees about 3 to 5 minutes to complete. They come to us. They're completely confidential. We submit them to the underwriters at the insurance company, and based on the information disclosed on those medical questionnaires, determines if you're going to be a good candidate for the level funded program or what your final rates would be at that time. As a solo attorney, I purchased an Exchange Blue Advantage HMO plan, $1,744 a month with extremely high deductibles and poor physician accessibility, as most will not take that policy. Can we implement a supplemental hospital gap insurance policy mid-year with a corresponding reduction to the existing policy? I have an HSA. I think the answer to that, and perhaps you can email me after this and we could I could firm up this answer, but I think for sure you could implement the gap policy at any time as long as you have a medical insurance plan in place. And I know on the individual market for some areas, some associations we work with, there's only HMO options. If you have any employees, one employee who is a W-2 and not your spouse, then we can actually look at a group policy for you if you have at least 2 people that are eligible. And then we'll continue to monitor the individual market for any other PPO or POS options that come available. But go ahead and just send me an email and I can give you a firm answer on the supplemental policy as well. In your opinion, what is the best alternative for a firm with 2 to 5 employees total, the HSA and the insurance, or the gap insurance? So that's a great question. For a group of 2 to 5 employees, do you offer a traditional insurance plan and just up your deductible and put the gap insurance in place, or put the health savings account in place? And I would say it depends on the needs and the demographics of your employees and kind of what their financial status would be. So HSAs tend to be great for people that say, I'm okay with paying a little, I'm okay with paying less premium and having a little bit of out-of-pocket expenses throughout the year, knowing that my annual savings is going to be very good and I'll save the money. But if I was to come across a situation where the employer said, my people, they're not going to save this money and they're not going to open HSA accounts, then I would tell them probably to go with the gap insurance option. So it just depends on your situation. You probably know your group best. I would say I would want to consider the HSA, and then perhaps you could make the gap insurance voluntary for them, where they could do both, as one of our previous listeners asked. So I would look at both. Is the HSA qualified plan typically more cost effective? Yes, typically if you compare it side by side to a traditional plan with copays or more predictable expenses, you are going to have some savings on the HSA qualified plan. How can we call you? You can just contact the number on the screen and just ask for me, or you can just send me a direct email and I'd be happy to help you. Can we meet with someone to look at plans side by side? Absolutely. So just give me a call and we can help you with that. Another question: my mother pays about $400 for her insurance. Unfortunately, her income is very limited. How can we best help her reduce those payments? Would you be able to assist her even if she is not an attorney? Yeah, so we would be happy to help. I know you're probably an attorney, so yeah, just have her give me an email or give us a call, and I'll set her up with the right person to help her. Yeah, appreciate the thank you. Thank you guys for joining too. How complex is the reimbursement for supplemental insurance? That's another great question. It's very simple. It's just a claim form that actually gets mailed to you once you sign up for the supplemental insurance plan. You fill it out. You can fax it or email it in, and then we just verify that you are still eligible and up to date on your premiums for the supplemental insurance, and then the reimbursement check would go directly to you. Are HSA plans at higher premium for the same coverage in comparable plans? HSAs are typically lower in premiums, but maybe you're asking something different there, so come back to me with another question if you are, or you can send me an email. Are we stuck with the medical plan we chose last November or December until next November? How can we change? That is a common question, and that a lot of people are misinformed on. You can change on the group side, I guess I should say. On the group side, you can change insurance carriers and plans at any time throughout the year. If you are on an individual plan right now, then you would need to continue until open enrollment or until you had some sort of a qualifying event. But on the group side, if you wanted to have us look at your group and see if you could come up with better options, we could do that for a 6/1 or a 7/1 or an 8/1 effective date, and that's very easy to do. We do that all the time. So any other questions? Give another minute or so if you have any other questions or anything that I already answered and you want some more clarification on, go ahead and type that in. Yeah, good question. What are typical qualifying events? Loss of coverage, involuntary loss of coverage, marriage, divorce, adoption, relocation, and losing your coverage. Those are the top ones. Thank you. I appreciate it. Happy to help with the information we provided. So thanks for your compliment there. Any other final questions? Okay, we got a couple more coming in. Did we answer how you can meet with somebody? Yes. You should see on my screen. Just go ahead and send me an email directly or call our 1-800 number and ask for me, and I will, depending on your situation, I will help set you up with the right person that you can meet with. I have very little knowledge on insurance regulation, how it works. That's probably the majority of people. Where can I read somewhere of how it works? Well, I would say we have a lot of stuff on our website. Again, you can contact me and I can have a brief conference call just to go through just the high level. We also have some other previous webinars we've done that have some good information on it. Okay, well with that, I appreciate your guys' time. I appreciate the compliments. Thank you so much, and we look forward to helping you in any way, and just look out for future webinars that we will have. Thanks and have a great day. We're going to go ahead and end the webinar now.